BCE and TD are two top stocks on the TSX, and they both offer really high yields of more than 5%. And today, I'm going to look at which one of these stocks is the better buy right now and to hold for the long term. So BCE offers a really high yield of around 8.8% right now, so extremely high. If you look at TD, it pays a yield of just under 5.3%. So both offer really high payouts. BCE obviously a much superior yield, but the danger with just looking at a high dividend yield is that it's usually high for a reason. It's not going to be a good reason, because what happens is a yield can get really high when investors are feeling bearish about a stock, because yield is a function of the stock price and the dividend. So as the stock price goes down, that yield is going to go up because you're collecting the same dividend but at a lower price. So you're getting more bang for your buck. So yield alone is not a reason to invest in the stock. And for me, I always consider when a stock's paying more than 5%, why is it paying such a high yield? Because in theory, if a yield is really high and the stock is safe, people should be buying it up, right? It should be taking off. The stock should be soaring. And if a stock soars, that yield's going to come down. But with BCE's yield still being at around 8.8%, that tells you, that investors aren't feeling all that great about the stock. And so it's always important to consider the reasons why it may be struggling and why it's not such a great buy. So I'll go over both BCE and TD. So with BCE, a big reason why it's been struggling is that rates have been increasing. Now recently there's been some rate cuts, but over the past few years, you can see there started this decline in around 2022, and that's when the markets weren't doing too well. The inflation was high, and interest rate cuts didn't help. So it's been struggling since around 2022. So that's a bit of a concern, but you might be feeling a bit more optimistic now because the Bank of Canada has been cutting rates, and there's the possibility that there could be even more rate cuts to come. Now, on the flip side, there's also the possibility of a slowdown in the economy and a recession. And so there not being a whole lot of growth for a company like BCE if people are cutting back on spending, on travel, those sorts of things. So those are kind of the big risks right now that BCE is facing. Overall, I still think that it's potentially undervalued and that it could be due for recovery, just because as those rates come down for a capital intensive company like BCE, that means its interest costs are going to go down. It's going to be its earnings should improve. So I think there's reason to be a bit more optimistic that it could recover. And as that happens, though, that yield could come down. So that's why, if you're thinking about buying the stock and you're willing to take the risk, it might be worth buying it now while its yield is still fairly high. But is it a better option than TD? TD right now yields 5.3%, so considerably less, but it's also facing its own problems related to money laundering in the US. And that's the reason why its earnings numbers have taken a hit recently and why they may continue to do so for at least the next quarter or two. And so another consequence it's facing is that there's going to be restrictions put in on its growth opportunities in the U.S. So that could also hinder the stock. And so that's another reason why people aren't too thrilled with TD of late. And if we look at its 5-year trend, it's still green, but not by much, 2.9%. So overall, it's weathered the storm better than BCE has, just because BCE is more capital intensive, and so it's going to be more vulnerable to its high debt loads. And TD is generally going to do well as long as the economy is doing well. So investing in bank stocks, especially top bank stocks, can be a good way to invest long term in the economy. That's why Warren Buffett really loves to own bank stocks, just because it's a really easy way to bet on the country's long-term success. So TD is another stock that I think could be overdue for a bit of a rally, just because it hasn't been doing all that well in recent years. It's been a bit stagnant of late, and so its yield could also come down. So which stock is the better option? So let's take a look at some charts to try to answer that question. So first thing I'm going to look at is the actual dividend. So over the past 10 years, there's been a fair bit of dividend growth from these stocks. So we can see TD's increased its dividend by 117%, BCE by 62%. So obviously the edge here goes to TD with the much faster dividend growth. But again, this is going to depend on the strength of the economy. If the economy is not doing well, if there's a recession, TD may not be as generous with its rate hikes, or it may even stop them. And so with a higher yielding stock like BCE, it might have there might be less of a reason, I guess I could say, to go with TD than BCE, especially if you assume the dividend is going to be safe for both companies, and TD is not increasing it as a high of a rate as in the past. Another thing to consider is the payout ratio. And so the payout ratio tells you how much of the company's earnings are paid out towards the dividend. The lower the payout, the more sustainable the dividend is, and the safer it is. Now, with a payout ratio, however, you want to be careful, because one bad quarter or earnings report can really skew the payout ratio. So the company has a big write-down, goodwill impairment charge, and earnings come down. That payout ratio is going to skyrocket higher. So one bad quarter, it can be a little bit misleading. And that's why looking at the trending can be really useful. So right now we can see TD's payout ratio spiked to 86%. And again, the company's been hit with fines and penalties, and set aside money for issues related to money laundering. So that's why its payout ratio has spiked a little bit. But normally you can see it's around 50% or even lower than that. So historically, its payout ratio has been fairly low. So I wouldn't be too concerned about this recent spike, just because the issues related to the money laundering charge, that's going to be a temporary issue. It's not going to persist for the long term. It might be a couple bad quarters for TD, but I expect this payout ratio to come down as well. Now with BCE, it's a bit of a different story, just because this is a stock that routinely has a fairly high payout ratio. Now it's been able to sustain that, but you can see over the years it's been steadily increasing and ballooned even higher now recently, just because the growth, it's been struggling with growth. It hasn't been doing well in terms of earnings. So it does appear to be a far riskier stock, and that's probably a big reason why that dividend yield isn't coming down and people aren't buying BCE for its dividend. Because if that payout ratio is really high, investors are going to be concerned, there could be a cut coming. But if earnings improve, and they could, as interest rates continue to come down, the company refinances debt, lowers its interest costs, then it may get back into the safe territory. But it's still a bit of a risky buy in that regard, just because it was always around this 100%, around 100%. So there is a bit more risk, I would say, with BCE stock than TD's. So overall, if I was picking between these two stocks today, I'd go with TD. Even though its yield is lower, the company's been increasing its dividend at a far faster rate than BCE. And with a much lower payout ratio, there's also room for it to continue to increase its dividend at a faster rate in the future. So I think that's a better option for the long term. BCE, I think, faces a bit more risk, just because its earnings aren't that great right now. And so management might be tempted to bring down that dividend a little bit, just because that'll improve cash flow, bring down the payout ratio, and that might attract some more dividend investors in the process, because they'll have more confidence in the dividend and its safety, as opposed to now, where they might be turned off by the fact that its payout ratio is as high as it is. But both stocks, I think, still have the potential to be really good buys, because I think as interest rates come down, BCE's earnings should improve, the payout ratio should come down, and that could help the stock. But anytime you can get TD when it's yielding more than 5%, I think is a steal of a deal, and it's one of the safest stocks you can own on the TSX. So I think you can't go wrong with it if you're buying for the long term.